Finance is first and foremost a decision science. So, imagine you have some money and you want to use it wisely. That's where finance comes in, and it's like a special kind of science called decision science. Now, instead of lab experiments and test tubes, decision science in finance uses smart methods and facts to make the best choices about money. Just like how scientists use data to find answers, finance experts and people like you and me use information and analysis to make smart money decisions. Why is this important? Well, think about it. Smart money moves. When you make decisions based on facts and information, you're more likely to make smart moves with your money. It's like using a map to find the best route instead of guessing blindly. Avoiding money mistakes. Decision science helps you avoid silly money mistakes caused by emotions. It's like thinking with your head instead of your heart when it comes to spending and saving. Growing your money. With decision science in finance, you can figure out the best places to put your money, like investments. It's like planting seeds in the right soil to make your money grow over time. Planning for the future. You can make a plan for the future and set financial goals with the help of finance as a decision science. It's like having a treasure map to find the hidden treasure of financial success. Being ready for anything. When you understand finance as a decision science, you can prepare for unexpected things that might happen. It's like having an umbrella when it suddenly rains, but this umbrella is for your money. So, by using finance as a decision science, you can make smarter choices with your money, avoid money troubles, and set yourself up for a more secure and successful future. It's like having a superpower that helps you take control of your finances and make them work for you. What is the rate of return? The rate of return is a way to figure out how much money you've gained or lost from an investment or financial decision. It's like checking how well your money did in a specific situation. To calculate it, you take the ending value of your investment and subtract the starting value. Then divide that by the starting value. Example. Let's say you invested $100 in a stock, and after a year, it grew to $120. The rate of return would be 120 to 100 / 100 equals 20%. Why are rates of return important? Rates of return are essential because they help you understand how successful your investment or financial decision was. Here's why they matter. Measuring success. Rates of return tell you how well your money is doing. If the return is positive, it means your investment made money. If it's negative, it means you lost some money. Comparing options. Let's say you have a few different ways to invest your money. By calculating the rates of return for each option, you can compare them and choose the one that gives you the best chance of making more money. Setting goals. When you know how much your investments are earning, you can set financial goals. For example, you might aim for a certain rate of return to help you reach a specific amount of money by a certain time. Risk assessment. Rates of return also help you understand the risk involved in an investment. Higher returns usually come with higher risks, and lower returns might be safer but offer slower growth. Learning from mistakes. If you see a negative rate of return, it's a chance to learn. You can figure out what went wrong and avoid making the same mistake in the future. Remember, rates of return are like a scorecard for your money decisions. They give you valuable information to make better choices and grow your wealth over time. Just keep in mind that all investments come with some level of risk, so it's essential to do your research and make informed decisions. How interest rates are determined. Think of interest rates like the price you pay to borrow money or the reward you earn for saving or lending money. The main entity that sets interest rates is the central bank of a country, like the Federal Reserve in the United States. They use interest rates to control the economy and keep things in balance. Major determinants of market interest rates: supply and demand. It's like buying and selling candy at school. If lots of people want to borrow money, high demand, interest rates go up because lenders can charge more. If fewer people want to borrow, low demand, interest rates go down to attract borrowers. Inflation. This is the general increase in prices over time. When prices go up, the value of money goes down, so lenders ask for higher interest rates to make up for it. Central bank actions. Remember the central bank we talked about earlier. When they want to encourage borrowing and spending, they lower interest rates. If they want to slow down the economy and control inflation, they raise interest rates. Economic conditions. If the economy is doing well, interest rates tend to go up because there's more demand for borrowing. If the economy is struggling, interest rates go down to encourage more borrowing and spending. Risk. It's like lending money to your responsible friend versus someone who's not so reliable. Lenders charge higher interest rates to riskier borrowers to compensate for the chance that they might not get their money back. Why are interest rates important? Interest rates affect almost everyone's lives, including yours. Here's why they matter. Borrowing and loans. If you want to get a car loan, a student loan, or a mortgage to buy a house, the interest rate will determine how much extra you have to pay back on top of the loan amount. Savings and investments. When you put your money in a savings account or invest in stocks or bonds, interest rates affect how much your money grows over time. Spending and saving habits. High interest rates might make borrowing expensive, so people might save more and spend less. Low interest rates can encourage borrowing and spending, boosting the economy. Housing market. Interest rates can influence the housing market. High rates might discourage people from buying homes, while low rates might lead to more home purchases. Business decisions. Companies also consider interest rates when making decisions about borrowing money for expansion or investments. Simple interest. Simple interest is like the most straightforward way of calculating interest. It's just a fixed percentage of the initial amount, the principal, that you borrow or invest. So every year, you get the same amount of interest based on the original money you had, regardless of how much interest you earned in previous years. Example. Let's say you borrowed $100 with a simple interest rate of 5% for 1 year. After 1 year, you'll owe $105, the original $100 plus $5 in interest. Compound interest. Compound interest is a bit different, but it's pretty cool. Here, the interest is calculated not only on the original money, but also on the interest you earned in previous periods. So as time goes by, you earn interest on both the initial amount and the interest that's already added to your total. Example, if you invest $100 with a compound interest rate of 5% for 1 year, you'd have $105 at the end of the year, just like with simple interest. But the exciting part is that if you leave that money for another year, you'll earn interest not only on the original $100, but also on the $5 interest you earned in the first year. So in the second year, you'll earn a bit more than $5 in interest. Why is it important? Growth over time. Compound interest is like a snowball rolling down a hill. As time goes on, it keeps getting bigger and bigger. So the longer you leave your money to grow with compound interest, the more you'll have in the end. Investing advantage. Compound interest is a big advantage when it comes to investing for the long term. It allows your money to grow faster and can help you build wealth over time. Borrowing costs. On the flip side, compound interest can make borrowing money more expensive over time. If you have a loan with compound interest, the total amount you owe can grow faster than with simple interest. Financial planning. Understanding simple and compound interest can help you plan for the future. Whether you're saving money, investing, or taking out loans, knowing how interest works will help you make better financial decisions. Time matters. The earlier you start saving or investing, the more advantage you get from compound interest. It's like planting a money tree. The sooner you plant it, the taller it grows and the more fruits it bears. In short, simple interest is straightforward and works for short periods. But if you want your money to grow faster over time, compound interest is your friend. Understanding the difference between the two can help you manage your finances and make the most out of your money. Let's break down the underlying theories affecting the term structure of interest rates. 1. Expectation theory. Imagine you want to lend your money to someone, but you're not sure what interest rate to ask for. The expectation theory suggests that the interest rate you'll demand depends on what you expect to happen in the future. If you think that interest rates will go up in the future, you might ask for a higher interest rate now. On the other hand, if you expect interest rates to go down, you might settle for a lower interest rate. Why is it important? Expectation theory helps lenders and borrowers make decisions about interest rates based on their predictions of what might happen in the future. It's like looking into a crystal ball to guess what the interest rates will be like in the coming days, months, or years. Understanding these expectations can help people plan better and manage their money wisely. 2. Liquidity preference theory. When you lend your money, you're taking a risk because you won't have access to it for some time. The liquidity preference theory says that people generally prefer to have their money available and accessible rather than tied up in long-term loans or investments. So, they might demand higher interest rates for longer-term loans to compensate for the risk of not having access to their money. Why is it important? Liquidity preference theory helps explain why interest rates might vary based on the time period of the loan or investment. It's like saying, I'm willing to lend you my money for a short time, but you have to pay me a little extra for not having access to it during that time. Understanding liquidity preference helps lenders and borrowers negotiate fair terms and decide how long they want to commit their money. 3. Market segmentation theory. Market segmentation theory suggests that interest rates are determined by different groups of lenders and borrowers with specific preferences. Some people might want to lend or borrow money for short periods, while others prefer longer periods. As a result, interest rates for various timeframes can vary based on the demand and supply of loans or investments in each market segment. Why is it important? Market segmentation theory explains why interest rates might not follow a consistent pattern across all time periods. It's like saying that the market is divided into different groups, and each group has its own rules and preferences for lending and borrowing money. Understanding this theory helps financial experts and policymakers analyze interest rate trends and design suitable policies to stabilize the economy. In summary, these underlying theories, expectation, liquidity preference, and market segmentation, play a significant role in shaping the term structure of interest rates. By understanding these theories, individuals, businesses, and policymakers can make informed decisions about borrowing, lending, and investing, contributing to a stable and balanced financial system. Let's break down the concept of opportunity cost in the context of a business decision, like investing in expanding the business or purchasing another business. Opportunity cost is all about making choices. When you have two or more options, the opportunity cost is the value of the next best alternative that you give up when you choose one option over the others. In simpler terms, it's what you miss out on when you make a decision. Imagine you're a business owner, and you have two exciting opportunities in front of you. Option A is to expand your current business by opening a new store, and option B is to buy another small business that complements your current one. Now, you have to think about what you'll gain and what you'll lose with each option. If you choose option A and decide to expand your current business, the opportunity cost would be the benefits you could have gained from option B, the business you didn't buy. Conversely, if you choose option B and buy the other business, the opportunity cost would be the advantages you could have gained from option A, the expansion you decided not to pursue. It's essential to consider opportunity cost because it helps you make better decisions. By analyzing the potential benefits and losses of each option, you can understand the full impact of your choice. In the business world, decisions often involve money, time, and resources. So, considering opportunity cost helps you prioritize your resources effectively. It allows you to identify which option gives you the best return on investment or the most significant advantage for your business. Remember, every time you make a choice, there's always something you're giving up. By thinking about opportunity cost, you become more aware of the trade-offs and can make wiser decisions for your business's growth and success. Let's dive into these analytic tools that help businesses make better decisions in simple terms. Interest rates equals cost of money. Okay, think of interest rates like the price you pay for using someone else's money. When you want to borrow money from a bank or someone else, they charge you a fee for letting you use their money. That fee is called an interest rate. So the higher the interest rate, the more money you'll have to pay back on top of the original amount you borrowed. It's like a rental fee for using the money. And in business, this is super important because it affects how much money you'll have to spend on loans and how it can impact your overall profit. TVM, time value of money, equals methods of evaluation. TVM is all about understanding that money's value changes over time. Imagine you have $100 today, and you can either keep it or invest it somewhere. If you keep it, it'll still be $100 tomorrow. But if you invest it wisely, it could grow into more money over time. So TVM helps you figure out how much money is worth now compared to what it might be worth in the future, considering things like interest or returns on investments. This is important because it helps you make better choices when you're deciding whether to spend money now or invest it for better returns in the future. Risk versus return equals safety. Now let's talk about risk and return. In business, every decision comes with some level of risk. Risk means the chance that things might not go as planned, and you could lose money or not get the results you hoped for. On the other hand, return is what you gain from that decision, like profits or rewards. So, it's like a balancing act. Some opportunities might promise big rewards, but they also have more risk. Others might be safer, but the rewards could be smaller. The key here is to find the right balance that matches your comfort level. Understanding the risk-return relationship is essential because it helps you make decisions that align with your goals and how much uncertainty you can handle. In a nutshell, these three tools are crucial for businesses because they help you manage your money wisely. By considering interest rates, you can make smart choices about borrowing and avoid unnecessary costs. Make better investment decisions. TVM allows you to evaluate different investment options and figure out which ones will give you the best return on your money over time. Balance risks and rewards. Understanding risk versus return helps you pick strategies that match your business's goals and how much uncertainty you're comfortable with. So, whether you're running your own business or planning to invest in one, these analytic tools will be your superpowers to make informed and successful decisions. Remember, the more you understand them, the better equipped you'll be to handle money matters like a pro. Interest rates. Interest rates are like the rental fee for borrowing money. When you borrow money from a bank or someone else, they charge you a percentage of the borrowed amount as interest. It's like paying for the privilege of using their money. Interest rates are essential because they affect how much you have to pay back on top of the original amount you borrowed. So if the interest rate is high, you'll have to pay back more, and if it's low, you'll pay back less. Required rate of return. The required rate of return is the minimum amount of profit or reward an investor expects to get from an investment. Imagine you're considering investing in a business or a project. You'd want to earn a certain amount of profit to make it worth the risk and effort. The required rate of return helps you figure out if the investment is worth it or not. If the potential return is higher than the required rate of return, it's a good investment. Otherwise, it might not be as attractive. Drivers of market interest rates. Market interest rates are influenced by several factors. The main ones are central banks. When the central bank of a country, like the Federal Reserve in the U.S., sets its interest rates, it can influence the overall market rates. Inflation. If prices for goods and services go up, inflation, lenders may charge higher interest rates to protect their money's value. Economic conditions. The overall health of the economy can impact interest rates. In a strong economy, rates might be higher, and in a weaker economy, rates might be lower. The term structure. The term structure refers to how interest rates vary for different timeframes. Sometimes short-term loans have lower interest rates, while long-term loans have higher ones. This is because lenders consider the risks and uncertainties associated with longer time periods. The term structure is essential because it affects how businesses and individuals plan their borrowing and investment decisions. Cost-push inflation versus demand-pull inflation. Inflation is when the general prices of goods and services in an economy go up. Two main causes of inflation are cost-push and demand-pull. Cost-push inflation. This happens when the cost of producing goods and services increases, and businesses pass on those higher costs to consumers by raising prices. Demand-pull inflation. This occurs when there's a surge in demand for goods and services, and businesses raise prices to match the high demand. Understanding inflation is crucial because it impacts the purchasing power of money. If prices rise too quickly, your money might not buy as much as it used to. Understanding the cost of money. The cost of money refers to the interest rate you have to pay when you borrow it. It's the price you pay for using someone else's money to fund your business, buy a house, or anything else. For businesses and individuals, Understanding the cost of money helps in making financial decisions, like whether it's a good time to take a loan or how to manage debts efficiently. Interest rate levels. Interest rate levels indicate how high or low interest rates are in the overall economy. High interest rate levels mean it's more expensive to borrow money, which can slow down spending and investment. Low interest rate levels, on the other hand, encourage borrowing and spending to stimulate economic growth. Central banks often adjust interest rate levels to help manage the economy. In conclusion, these concepts are important because they shape how money flows in the economy, influence investment decisions, and impact the overall cost of living. Understanding these financial principles empowers you to make informed choices about borrowing, investing, and managing your money, whether you're running a business or handling personal finances. Let's break down these key notes about interest rates and required return interest rates. The cost of money. Imagine you want to borrow some money from a bank to buy a car or start a business. Well, the bank won't just give you the money for free. They charge you a little extra money called interest when they lend you the cash. It's like a rental fee for using their money. Interest rates tell you how much extra money you have to pay back on top of the original amount you borrowed. So higher interest rates mean you'll have to pay back more money, and lower interest rates mean you'll pay back less. Required return. What investors expect. Now, let's talk about the required return. This is like what smart investors expect to get as a reward for letting someone else use their money. Imagine you're an investor, and you have some extra money to invest in a project or a business. You want to get some profit from that investment, right? The required return is the minimum amount of profit or return you expect to earn. It's like setting a goal for how much money you want to make from your investment. Risk-free rate and risk premium. The risk-free rate is the interest rate on something super safe, like U.S. Treasuries, a type of government bond. These investments are considered very low risk because the chance of the government not paying you back is super tiny. But most investments carry some level of risk. So when you invest in riskier things like stocks or small businesses, you want to be rewarded for taking that risk. That's where the risk premium comes in. It's like a little extra bonus investors expect to get for investing in riskier stuff. The required return is calculated by adding the risk-free rate and the risk premium together. Now, why are these things important? Here's why. Borrowing decisions. If you're planning to take a loan for something like buying a house or starting a business, understanding interest rates is crucial. Higher interest rates mean you'll have to pay back more money over time, so you'll want to find the best deal with lower rates. Investment choices. If you have some extra money and want to invest it wisely, knowing about required return and risk is vital. You want to make sure your investment has a good chance of earning you a decent profit, and that depends on how much return you expect and how much risk you're willing to take. Economic impact. Interest rates and required return also affect the overall economy. When interest rates are high, people might borrow and spend less, which can slow down the economy. On the other hand, lower interest rates can encourage people to spend and invest more, which can boost economic growth. So these concepts help us make smart choices about money, borrowing, and investing, and they also have a big impact on how our economy works. Understanding them gives us the tools to manage our finances and make informed decisions that benefit us and the businesses we might be involved with. Let's break down the concept of interest rate mechanics, specifically simple interest rates and compound interest rates, simple interest rates. Imagine you put $100 in a savings account that offers a simple interest rate of 10%. With simple interest, you only earn money on the original $100 you deposited. There's no interest on interest happening here. So, after 1 year, you'd earn $10 in interest, 10% of $100. And your total savings would become $110. $100 original plus $10 interest. Now, here's the important thing about simple interest. Each year, you earn the same amount of interest based only on the initial $100 you put in. So after 10 years, you'll earn a total of $100 in interest, $10 x 10 years, and your total savings will be $200. $100 original plus $100 in interest. Compound interest rates. Now let's talk about compound interest. Imagine you have another savings account with the same initial $100 deposit and a compound interest rate of 10%. The magic of compound interest is that you not only earn money on the original $100, but also on the interest you earned in previous years. So in the first year, you'd earn $10 in interest, just like with simple interest. But here's the difference. In the second year, you don't just earn $10 on the initial $100. You earn 10% on the total amount you had at the end of the first year, which is $110. So in the second year, you earn $11 in interest, 10% of $110. Now in the third year, you'll earn 10% on the total amount you had at the end of the second year, which is $121. $110 plus $11. And this goes on each year, with the interest building on top of the interest from previous years. After 10 years of compound interest, your total savings will be $259.37. That's significantly more than the $200 you earned with simple interest. Why is this important? Compound interest is incredibly powerful and can make a big difference over time. It's like your money is growing faster and faster as the interest keeps adding up. This is why starting to save and invest early can be so beneficial. The longer your money stays invested, the more it benefits from the interest on interest effect. On the other hand, simple interest is straightforward and predictable. It's usually used for short-term loans or simple savings accounts. However, for long-term investments, compound interest is the way to go if you want your money to grow significantly over time. Understanding the difference between simple and compound interest helps you make informed decisions about where to keep your money, how to pay off loans, and how to grow your savings effectively. So, whether you're saving for a big purchase or investing for your future, knowing about interest rate mechanics can be a game changer for your financial success. Key drivers of interest rates: risk-free cost of capital. Imagine you want to borrow money from someone. The risk-free cost of capital is like the starting point or the minimum amount that the person lending you money would expect to get back. It's the interest rate you would pay on a completely safe investment where there's almost no chance of losing money, like putting money in a government-backed savings account. This rate serves as a baseline for other investments because if someone is going to lend you money for a riskier investment, they'll expect a higher return to compensate for the extra risk. Inflationary expectations. Think of inflation as the general increase in prices over time. When you hear people say that things are getting more expensive, that's inflation at work. Inflation can eat away at the purchasing power of your money, meaning that the same amount of money won't buy as much in the future. When lenders lend money, they want to make sure that they'll get back an amount that can still buy as much in the future as it can today. So, they consider inflation expectations when setting interest rates. If they expect prices to rise, they'll want a higher interest rate to make up for the loss in purchasing power. Level of risk in the investment. Investing money is like taking a chance on something that may or may not give you good returns. Some investments are riskier than others. For example, investing in the stock market is riskier than putting money in a bank account. The level of risk in an investment affects the interest rate because people will demand a higher return for taking on more risk. If an investment is considered risky, lenders will charge a higher interest rate to compensate for that risk. Costs of the transaction. Every time you borrow money or invest, there are costs involved. These could be things like administrative fees, paperwork costs, or any other expenses related to the transaction. These costs are factored into the interest rate, meaning that the interest rate will be slightly higher to cover these expenses. These factors are important because they determine how much it will cost to borrow money or invest in something. For example, if you want to take out a loan to buy a car or start a business, the interest rate will determine how much extra you have to pay back to the lender. Understanding these drivers can help individuals and businesses make better financial decisions and be aware of the risks and costs involved in borrowing or investing money. It also helps to compare different investment opportunities and decide which one makes the most sense based on their risk and return potential. Let's break down the term structure of interest rates and the three theories in simple terms for an 18-year-old. Term structure of interest rates. The term structure of interest rates refers to how interest rates change depending on the length of time of an investment or loan. In general, if you're willing to lend your money or invest it for a longer time, you can usually expect to get a higher interest rate. This is because longer-term investments carry more uncertainty and risk, and lenders want to be compensated for waiting a longer time to get their money back. Normal and inverted curve. Under normal conditions, interest rates tend to rise as the length of time of an investment increases. This means that if you look at a graph showing different interest rates for different loan durations, like 1 year, 5 years, 10 years, etc., the graph usually goes up as you move to longer time periods. This normal curve reflects the general expectation that longer-term investments should offer higher returns due to the risks and uncertainties involved in the long run. However, there can be times when the graph looks inverted, meaning that short-term rates are higher than long-term rates, which can happen during unusual economic situations. The three theories. Expectation hypothesis. This theory suggests that the long-term interest rates are determined by what investors expect the short-term interest rates to be in the future, plus an additional premium for taking on more risk. Imagine you have some money and are trying to decide whether to lend it for a short time or a long time. If you expect short-term interest rates to go up in the future, you might choose to lend for a longer time to lock in a higher interest rate. So the expectation of future short-term rates plays a big role in determining long-term rates. Liquidity premium theory. According to this theory, long-term interest rates not only depend on short-term rate expectations, but also include an extra premium for investors who are willing to hold onto long-term bonds. This premium compensates investors for the risk and uncertainty associated with keeping their money tied up for a more extended period. It's like getting a little extra reward for being patient and not needing your money back right away. Segmented market theory. In this theory, it is believed that short-term and long-term investments are like two separate markets that don't directly influence each other. People who invest in short-term securities might not be interested in long-term ones, and vice versa. As a result, the interest rates for short and long-term investments are determined by the balance of supply and demand in their respective markets. If there's a higher demand for long-term investments, the interest rates for long-term loans will be affected. Why are they important? Understanding the term structure and the theories behind it is crucial because it affects how businesses, governments, and individuals make financial decisions. For example, if interest rates are higher for long-term loans, businesses might be more hesitant to invest in long-term projects, and consumers might think twice before taking out long-term loans like mortgages. These concepts also influence how central banks and policymakers manage the overall economy by adjusting short-term interest rates to control inflation and promote economic growth. Having a basic understanding of these concepts can help you make informed financial choices in the future. Whether you're considering getting a loan, investing your money, or just trying to understand how the economy works, knowing about interest rates and the term structure will give you a good foundation for financial literacy. Explain cost push and demand pull inflation. Cost push inflation. Imagine you have a favorite burger restaurant that makes the most delicious burgers in town. People love their burgers so much that they always line up to buy them. Now, let's say the cost of ingredients used to make those yummy burgers, like meat and cheese, suddenly goes up. Since the restaurant wants to maintain its profits, they have two choices: either raise the prices of the burgers or make fewer burgers to keep their costs down. Now let's look at what happens. Production at full capacity. The burger restaurant is already making as many burgers as they can because they have limited space, staff, and equipment. So, they can't increase production to meet the higher demand caused by their popularity. Costs rise, supply drops. Due to the increased ingredient costs, the restaurant might decide to make fewer burgers or even reduce their menu options. As a result, the supply of burgers in the market decreases, even though people still want to buy the same number of burgers. No change in demand. People still love those burgers, and they are willing to pay the same price for them because they are so tasty. So the demand for burgers remains the same, even though the supply has gone down. Companies charge more. Since there are fewer burgers available, the restaurant that can still keep making them might raise their prices. And as a result, you and other burger lovers have to pay more for the same delicious burgers. Why is it important? Cost-push inflation is essential to understand because it can affect your everyday life. When the prices of goods and services go up because of increased production costs, your purchasing power may be reduced. In simple terms, your money might not buy as much as it used to, so you may feel like things are getting more expensive. Demand pull inflation. Now let's talk about demand pull inflation. Imagine a new gadget, like a super cool gaming console, is released, and everyone wants to have it. The demand for this gaming console shoots through the roof because people can't wait to get their hands on it. However, the company that makes these consoles can only produce a limited number of them at a time due to production constraints. Let's see how demand pull inflation works. High demand. Everyone is excited about this new gaming console, and they all rush to buy it. The demand is so high that it outpaces the number of consoles the company can produce. Limited supply. The company can't keep up with the massive demand because they can't produce enough consoles quickly. So, there aren't enough consoles available in the market. Prices go up. When something is in high demand but in short supply, people are willing to pay more to get it. So, the company might decide to raise the price of the gaming console to make the most out of the huge demand. People pay more. As a result, you and others who really want the gaming console may end up paying a higher price to get your hands on one because the demand is pushing the prices up. Why is it important? Understanding demand pull inflation is crucial because it can affect how much you pay for popular products and services. When there's a lot of demand but not enough supply, companies may raise their prices, making it costlier for you to buy the things you want. It's essential to keep an eye on inflation, as it can impact your overall cost of living and your purchasing decisions. In summary, cost push inflation happens when production costs rise, leading to reduced supply and higher prices, while demand pull inflation occurs when high demand for a product or service leads to price increases due to limited supply. Being aware of these types of inflation helps you understand why prices change and how it can impact your finances and the economy as a whole. Let's delve further into demand pull inflation. In simple terms, demand pull inflation. Imagine you have a favorite clothing store that sells trendy clothes. Now, picture a situation where a famous celebrity is spotted wearing one of their new designs, and suddenly, everyone wants that particular outfit. The demand for those clothes skyrockets because everyone is rushing to buy them to look stylish like the celebrity. Here's how demand pull inflation works. Production not at full capacity. The clothing store was producing clothes to meet regular demand, but now they are not prepared for this sudden surge in people wanting the trendy outfit. They can't make enough clothes quickly because they have limited sewing machines, workers, and resources. Demand increases. So many people are trying to buy this particular outfit that the store can't keep up with the number of orders pouring in. The demand for the clothes far exceeds what the store can supply. Companies must increase spending. To cope with the increased demand, the store needs to produce more clothes. This might mean they have to hire more staff, pay overtime to workers, and invest in additional equipment and materials. Companies charge more. Since the store has to spend more to meet the higher demand, they might decide to raise the prices of the trendy outfits. They do this to cover their increased costs and also because they know people are willing to pay a premium to get their hands on the fashionable clothes. People pay more. As a result, you and other fashion-conscious customers may end up paying more for that trendy outfit because the demand for it is pushing the prices higher. Why is it important? Demand pull inflation is essential to understand because it can have an impact on your spending and overall economy. When demand for certain goods and services rises significantly, prices tend to go up, making those items more expensive. As a consumer, this means you might have to pay more for the things you want, especially for popular or trendy items. From an economic perspective, demand pull inflation is considered a sign of a healthy and growing economy because it shows that people have the money and confidence to spend on goods and services. However, if it becomes too rapid or uncontrolled, it can lead to problems like higher living costs, reduced purchasing power, and challenges for policymakers in managing inflation. Understanding demand pull inflation can help you make smarter spending decisions. You might want to consider whether you really need a trendy item that's in high demand and costs more, or if it's better to wait until the hype dies down and prices normalize. Being mindful of inflation and its impact on prices will empower you to be a more informed and financially savvy consumer. Let's continue exploring the cost of money, focusing on the time value of money, time preference, and opportunity cost time value of money. Imagine you have $100 right now. You can choose to spend it immediately, maybe on a fun outing with friends, or you can decide to save it for the future. The time value of money is the idea that money you have now is worth more than the same amount of money in the future. Why is this? Well, if you have money today, you can use it for things you want right away, like buying a new gadget or treating yourself to a delicious meal. But if you wait to get that money in the future, you miss out on enjoying those things in the present. Additionally, if you decide to save or invest that money, it can grow over time through interest or profits, making it even more valuable in the future. So, people often think about whether to spend money now for immediate pleasure or save it for future benefits. Time preference. Time preference is related to how much you value money at different points in time. Imagine someone offers you $100 today or $100 a year from now. Which would you prefer? Most people would choose to have the money today because they can use it right away. Time preference is about deciding between immediate consumption, using money now, and deferred consumption, using money in the future after it has grown through investment. Opportunity cost. Opportunity cost is the concept that when you make a choice, you have to give up other options. It's like saying, if I choose to do one thing, I'm giving up the opportunity to do something else. For example, if you decide to spend your money on buying new clothes, your opportunity cost is the potential benefit or profit you could have gained if you had invested that money in something else, like a business venture or your education. Why are they important? Understanding the cost of money, time value, time preference, and opportunity cost is essential because they influence your financial decisions and their outcomes. They remind us that every decision we make involves trade-offs, and the best choice depends on our individual goals and priorities. These concepts can help you make more informed financial choices. When deciding whether to spend or save money, consider the time value of money, how spending now brings immediate enjoyment, while saving and investing could lead to more significant rewards in the future. Think about your time preference, whether you prioritize instant gratification or are willing to wait for more substantial benefits later. And always be aware of opportunity costs as they prompt you to consider the alternatives you are giving up when making financial decisions. Overall, having a good grasp of these ideas will empower you to be more thoughtful about your financial choices and help you work towards achieving your long-term goals and aspirations. It's essential to balance your present desires with future needs and make choices that align with your overall financial well-being. Let's break down the key concepts related to interest rate levels, the role of the Federal Reserve, and the impact of monetary and fiscal policies' federal funds rate. The Federal Reserve, or the Fed, is the central bank of the United States, responsible for managing the country's monetary policy. One of the ways the Fed influences the economy is by targeting the federal funds rate. This is the interest rate that banks charge each other for short-term loans of their reserves, which are the funds they hold at the Federal Reserve. Expansionary monetary policy. When the economy is in a recession and unemployment is high, the Fed might use an expansionary monetary policy. This means they lower the federal funds rate. By doing this, they make it cheaper for banks to borrow money from each other and, in turn, make it easier for businesses and consumers to borrow money from banks. The goal is to encourage businesses to expand and invest, and for consumers to spend more, which can help stimulate economic growth and reduce unemployment. Contractionary monetary policy. On the other hand, if the Fed is concerned about high inflation, they might implement a contractionary monetary policy. This means they increase the federal funds rate. By raising interest rates, borrowing becomes more expensive for businesses and consumers. This can lead to reduced spending and investment, which can help slow down inflation by reducing overall demand in the economy. Crowding out. Now let's talk about crowding out. Sometimes the government might implement expansionary fiscal policy, such as lowering taxes, to stimulate economic growth. When taxes are cut, consumers have more money to spend, which can boost economic activity. However, when the government reduces taxes, it also reduces its revenue, the money it collects in taxes. To address this revenue shortfall, the government might need to borrow more money by issuing government bonds. When the government borrows more money, it competes with private businesses and consumers for funds in the financial markets. To attract lenders, people willing to lend money to the government offers higher interest rates on its bonds. As a result, interest rates in general rise in the economy. Higher interest rates can lead businesses to reduce their borrowing and investment, and consumers might also cut back on spending. This reduction in spending and investment can slow down economic growth, which is why it's referred to as crowding out. It means that the positive effects of tax cuts might be partially offset by higher interest rates and reduced private sector spending. Why are they important? Understanding these concepts is crucial because they show how decisions made by the Federal Reserve and the government can impact the overall economy. Interest rates affect how easy or difficult it is for businesses and individuals to borrow money, which, in turn, influences spending, investment, and economic growth. Additionally, the balance between expansionary and contractionary policies plays a vital role in stabilizing the economy during times of recession or controlling inflation during periods of high economic activity. Knowing about these policies and their effects will help you better understand the broader economic landscape. They can also give you insights into how government decisions can impact the job market, interest rates on loans, like student loans or mortgages, and overall economic conditions that can affect your financial future. Hello, everyone. Today, we are going to delve into the world of finance, which is essentially a decision science. Finance helps us make informed choices about money and investments. Tonight's discussion will focus on analytic tools that aid in making business decisions, such as interest rates, time value of money, risk versus return, and inflation. Don't worry if you're not a finance expert. You don't need to be a mechanic to know how to drive. Interest rates and required return. Interest rates represent the cost of money and are typically charged by lenders when we borrow. They are based on the required return, which is what rational investors expect for using their money. The risk-free rate is the interest rate on U.S. Treasuries, considered free of default risk. As most investments carry some risk, we add a risk premium to motivate investors to provide funds. The required return is calculated as the risk-free rate plus the risk premium. Example question: what is the required return on an investment if the risk-free rate is 2% and the risk premium is 4%? Answer: the required return would be 6%, 2% plus 4%. Interest rate mechanics. Interest rates can be classified into simple interest rates and compound interest rates. Simple interest rates earn money only on the original funds, while compound interest rates earn money on both the initial amount and any accumulated interest. Drivers of interest rates. Interest rates are influenced by several factors, including the risk-free cost of capital, inflationary expectations, the level of risk in the investment, and transaction costs. Assuming perfect information, inflation expectations are built into risk-free instruments. Term structure of interest rates. The term structure of interest rates refers to how interest rates vary with the maturity or time period of an investment. Generally, longer maturities yield higher interest rates. There are three theories to explain this: expectation hypothesis, liquidity premium theory, and segmented market theory. Example question: what does an upward sloping term structure of interest rates indicate? Answer: an upward sloping term structure implies that longer maturities have higher interest rates, indicating higher uncertainty and risks in the long term. Types of inflation. Cost push versus demand pull. Inflation can be classified as cost push or demand pull. Cost push inflation occurs when costs rise, leading to reduced production and increased prices. Demand pull inflation occurs when demand exceeds production capacity, leading to increased prices. Understanding the cost of money. Time value of money. The time value of money assumes people are rational and have a preference for receiving money now rather than later. It involves considering the opportunity cost of choosing one investment over another. Example case: if you were offered $100 now or $110 a year later, which option would you prefer and why? Answer: most people would prefer $110 a year later, as it offers a higher return due to the interest earned. Interest rate levels and monetary policy. Interest rates in the U.S. are influenced by the Federal Reserve. Expansionary monetary policy aims to combat unemployment by lowering interest rates to encourage business expansion. Contractionary monetary policy increases interest rates to control inflation. Example case. How does expansionary monetary policy impact interest rates? Answer. Expansionary policy lowers interest rates, making credit more accessible and stimulating. Business expansion. Conclusion. Finance is an essential decision science, guiding us in making informed choices about money and investments. Understanding interest rates, inflation, and the time value of money is crucial for effective financial planning. By analyzing these factors, businesses and individuals can make better financial decisions and achieve their goals. Keep learning and remember, finance doesn't have to be complicated to drive successful outcomes. Welcome, everyone. Today, we will explore the fascinating world of finance, which is essentially a decision science. Finance plays a crucial role in helping businesses make informed choices to achieve their goals. We will discuss some essential analytic tools used in finance, including interest rates, time value of money, risk versus return, and inflation. So, let's dive in. 1. Interest rates and required return. Interest rates represent the cost of borrowing money. They are typically charged by lenders to borrowers. The required return is the expected return that rational investors demand for the use of their money. Formula for required return. Required return equals risk-free rate plus risk premium importance of interest rates. Interest rates impact various financial decisions, such as borrowing, investing, and saving. Rational investors demand a higher return for riskier investments. Example question. Why would an investor expect a higher return for a risky investment? Answer. An investor expects a higher return for taking on additional risk because they want to be compensated for the possibility of losing money on that investment. 2. Interest rate mechanics. There are two types of interest rates, simple and compound. Simple interest rates. You earn money only on the original funds, with no interest on interest. Compound interest rates. You earn money on both the original funds and any previously earned interest. Yes, there's interest on interest. 3. Drivers of interest rates. Interest rates consider various factors, such as the risk-free cost of capital, inflationary expectations, level of risk in the investment, and transaction costs. 4. Term structure of interest rates. The term structure refers to the relationship between the maturity of an investment and its corresponding yield, interest rates. Typically, longer maturity investments offer higher yields. Example case. In a normal curve, interest rates rise as the time lengthens. This is because longer-term investments carry more risk and uncertainty. 5. Types of inflation. Cost push versus demand pull. Inflation can be caused by rising production costs, cost push, or increased consumer demand, demand pull. Example question. How do companies react to cost push inflation? Answer. Companies may produce less and charge higher prices to offset increased production costs during cost push inflation. 6. Understanding the cost of money. Time value of money, TVM. TVM assumes rationality and considers time preference and opportunity cost. Time preference. Would you prefer to receive money now or later? Opportunity cost. It refers to the trade-offs between different investment choices. Example case. If you choose to invest $5,000 in a friend's business, your opportunity cost is the potential profit you could have earned from other investments. 7. Interest rate levels and monetary policies. The Federal Reserve, the Fed, in the U.S. implements monetary policies that impact interest rates. Expansionary monetary policy. Lowering interest rates to combat unemployment during a recession. Contractionary monetary policy. Raising interest rates to control inflation. Crowding out. When government borrowing leads to rising interest rates, reducing private sector investment spending. Conclusion. Finance provides valuable tools to make well-informed business decisions. Understanding interest rates, inflation, time value of money, and monetary policies is crucial for success in the financial world. So remember, you don't need to be a mechanic to drive in the world of finance. Let's navigate this exciting journey together. Hello everyone. Today, we will delve into the fascinating world of finance, which is primarily a decision science. Our discussion will focus on the analytical tools used to make important business decisions. We will explore interest rates, the time value of money, and the relationship between risk and return. Let's get started. Interest rates and required return. Interest rates are the cost of borrowing money from lenders. They are determined based on the required return that rational investors would expect for using their money. The risk-free rate, usually based on U.S. Treasuries, represents the return with zero default risk. Since most investments carry some level of risk, we add a risk premium to motivate investors to provide funds. Example question: why do we add a risk premium to interest rates? Answer: we add a risk premium to compensate investors for taking on additional risk when investing in assets that are not risk-free. This premium encourages investors to participate despite the higher risk. Interest rate mechanics. There are two types of interest rates: simple interest rates and compound interest rates. With simple interest, you earn money only on the original funds, while compound interest allows you to earn money on both the initial investment and any interest previously earned. Example case: if you invest $100 at a simple interest rate of 5%, how much will you have after 1 year? And what if it's compound interest? Answer: with simple interest, you'll have $105. Original $100 plus 5% interest. With compound interest, you'll have $105.25. $100 plus 5% interest on $100. Drivers of interest rates. Interest rates consider various factors, including the risk-free cost of capital, inflationary expectations, the level of investment risk, and transaction costs. Assuming perfect information, inflation expectations are built into risk-free instruments. Term structure of interest rates. The term structure shows the relationship between interest rates and the maturity time of investments. Under normal conditions, rates rise as time lengthens. The term structure can be upward sloping, normal curve, or downward, inverted. Example question: what factors might cause an inverted term structure of interest rates? Answer: an inverted term structure could be caused by concerns about economic recession or deflation, leading investors to seek long-term safe investments. Types of inflation. Cost push versus demand pull. Cost push inflation occurs when production is at full capacity and costs rise, leading to reduced supply and higher prices. Demand pull inflation, on the other hand, happens when production is not at full capacity, demand increases, and companies raise prices to meet the higher demand. Example case: during an economic boom, what type of inflation is more likely to occur, cost push or demand pull? Answer: during an economic boom, demand for goods and services usually increases, leading to demand pull inflation as companies charge higher prices to meet the rising demand. Understanding the cost of money. Time value of money. Time value of money assumes that people are rational in their financial decisions. It considers the preference of receiving money now or later, taking into account opportunity costs. Example question: how does the time value of money affect your decision to invest money today or spend it now? Answer: if you invest money today, it will grow over time due to interest, allowing you to have more money later. If you spend the money now, you forego potential interest and future benefits from investing. Interest rate levels and monetary policy. The Federal Reserve, the Fed, plays a crucial role in the U.S. economy by implementing monetary policies. Expansionary monetary policies lower interest rates to combat unemployment during a recession. Contractionary monetary policies increase interest rates to control inflation. Example case: during an economic downturn, what type of monetary policy is the Fed likely to adopt? Answer: during an economic downturn, the Fed is likely to adopt expansionary monetary policy, lowering interest rates to encourage borrowing and stimulate economic growth. Conclusion: congratulations! You've now learned about interest rates, the time value of money, and their significance in finance decision-making. Remember, finance is like driving a car. You don't need to be a mechanic to understand how to make sound financial decisions. By grasping these concepts, you'll be better equipped to make informed choices in your financial journey. Happy decision making. Imagine you want to make some smart decisions about where to invest your money. To do that, you need to understand a few key things: interest rates, required return, and inflation. The required rate of return is the minimum percentage of profit an investment needs to make so that people or companies are willing to put their money into it. This rate depends on how risky the investment is and what other options are available. Interest rates are the extra money you have to pay when you borrow money or the money you earn when you invest it. They directly affect how expensive it is to borrow and can impact your financial decisions. When people want to invest, they usually look at the risk-free interest rate, which is the safest way to invest your money, like depositing it in a government-backed savings account. But most investments involve some risk, and to compensate for that risk, investors expect a higher return, called a risk premium. The financial markets are where people trade assets like stocks, bonds, currencies, and commodities. Prices of these assets go up and down depending on supply and demand, and what investors expect in terms of returns. So the prices you see in the markets already include the returns investors require for taking on that investment. In a nutshell, when you're looking to invest, you want to find opportunities that will give you a return higher than what you get from a safe investment, like a savings account. The rate of return is like the profit you make on your investment, and it's influenced by interest rates, risk, and what other investors are doing in the market. I'll break down the topic and provide some mental models and exercises to help you understand it better. Simplified explanation. Think of investments as opportunities to make money. When you invest your money in something, you want to earn a profit on it. The required rate of return is the minimum amount of profit you expect from an investment to make it worth your while. It depends on how risky the investment is and what other options are available to you. Interest rates play a big role in this because they determine the cost of borrowing money or the money you earn when you invest it. The financial markets are like a big marketplace where people buy and sell assets like stocks, bonds, and currencies. Prices in these markets already include the returns investors expect to get. Mental models and analogies. Think of your investment as a plant you're growing. The required rate of return is like the amount of sunlight and water the plant needs to grow well. If it doesn't get enough, it won't grow as much as you want it to. Imagine interest rates as the price you have to pay to borrow a friend's bike. If the price is too high, you might decide it's not worth it and look for another option. Example exercises. Calculate the required rate of return for an investment. You have an opportunity to invest in a project that will give you $150 in 1 year. However, you want a 10% return on your investment. Is this project worth it for you? Understanding the impact of interest rates. If you borrow $500 from a bank with an interest rate of 5%, how much interest will you have to pay at the end of 1 year? Answers to exercises. To calculate the required rate of return, use the formula. Required rate of return, RRR, equals profit from investment / initial investment. Asterisk 100 RRR equals $150 / $1,000. Asterisk 100 equals 15% since your required rate of return is 10%. The project is worth it for you because the return is higher than what you expect. To calculate the interest, use the formula. Interest equals principal amount asterisk interest rate / 100 interest equals $500 asterisk 5 / 100 equals $25. You will have to pay $25 as interest at the end of 1 year. 4. Advantages and disadvantages and importance. Understanding interest rates, required return, and inflation is crucial for making wise financial decisions. Here's why it's important. Advantages. Knowing the required rate of return helps you evaluate investments and make better choices. You can compare the potential returns with your expectations to decide if it's worth investing. Understanding interest rates enables you to manage borrowing and debt effectively. Disadvantages. Ignoring these factors can lead to poor financial choices. You might invest in projects that don't meet your expectations or borrow money without realizing the true cost due to high interest rates. Overall, having a grasp of these concepts empowers you to make informed financial decisions, grow your wealth, and avoid unnecessary risks. 2 key points you should know in depth about interest rates, required return, and inflation. Required rate of return, RRR. It's the minimum percentage of profit an investment needs to make for people or companies to be willing to invest in it. RRR considers the risk and reward trade-off. Risk-free interest rate. This is the starting point for assessing RRR. It's the interest rate on very safe investments with little risk, like government-backed bonds. Compound interest. When you invest money, it earns interest, and over time, that interest can also earn interest. This is called compound interest, and it helps your money grow faster. Interest rates and borrowing. Higher interest rates make borrowing more expensive because you have to pay back more money in addition to the original loan amount. Supply and demand impact. Interest rates are influenced by the balance between the amount of money available for lending supply and the amount of money people want to borrow demand. Yield. Yield is the return or profit you get from an investment, like dividends from stocks or interest from bonds. It's usually reported as an annual percentage. Risk premium. All investments have some level of risk. Investors require a higher return, known as the risk premium, to compensate for taking on more risk. Rational investors. Investors are assumed to be rational and risk-averse, meaning they want to maximize their return while minimizing risk. Financial markets. These are places where assets like stocks, bonds, currencies, and commodities are bought and sold. Prices of assets reflect the required returns by investors. Price discovery. The process in financial markets where buyers and sellers determine the value of assets based on available information and market conditions. Inflation. Inflation is the rise in the general price level of goods and services over time. It erodes the purchasing power of money, so investments should outpace inflation to grow wealth. Real versus nominal returns. Real returns adjust for inflation, showing the actual increase in purchasing power, while nominal returns do not consider inflation. Understanding these key points will help you make informed financial decisions, choose suitable investments, and manage risk effectively. It's essential to keep learning and staying informed about changes in the financial landscape to make the best choices for your money. Yield and interest rate are essential concepts for investors, especially those who deal with bonds or certificates of deposit CDs. Let's break them down in simple terms. Yield. Yield is like the money you make from an investment over a certain period. It includes different ways you earn money from that investment, such as interest and dividends. For example, if you invest in a company's stock, you may get some money back regularly as dividends. Yield is usually mentioned as an annual percentage of your investment. It's important to understand that yield can change if the investment or the company's situation changes. Interest rate. When you borrow money from a bank or a lender, they charge you something extra called interest. This interest is a percentage of the amount you borrowed, and you have to pay it back along with the original loan. The interest rate shows you how much extra money you need to pay back for borrowing. The interest rate can be different depending on the loan and who you are borrowing from. For example, if you borrow $1,000 from a bank for a year, and the interest rate is 10%, you will have to pay back the $1,000 you borrowed and an additional $100 as interest. The interest rate can be either simple or compounded. Simple interest means you only pay interest on the original amount you borrowed, while compounded interest means you also pay interest on the interest that accumulates over time. Interest rates are important because they affect how much you pay when you borrow money or how much you earn from certain investments like bonds. Interest rates can change based on various factors, and one of the significant factors influencing interest rates is the Federal Reserve's guidance. In summary, yield is the money you make from an investment, while the interest rate is the extra money you pay when you borrow money. Both yield and interest rates can be influenced by different factors and can change over time. Yield is like the profit you make from an investment, such as stocks or bonds, over a certain period. It includes the money you earn from interest and dividends. Interest rate is the extra money you have to pay back when you borrow money, and it's shown as a percentage. It also tells you how much regular return you can expect from certain investments. Mental models/analogies. Yield as crop harvest. Think of yield like the harvest from a farm. When you invest your money, it's like planting seeds. The yield is the crop you get back as profit over time. Just like a good farmer aims for a bountiful harvest, investors want a high yield from their investments. Interest rate as rent on borrowed money. Imagine you borrowed money from a friend to buy something. Your friend might ask for some extra money as rent for letting you use their money. The interest rate is like that rent percentage your friend charges you. The longer you use the money, the more rent you'll pay. Example exercises. A. Yield calculation. You invest $1,000 in a bond that pays 5% interest each year. Calculate your yield after 1 year. Answer. Yield equals $1,000 asterisk 5% equals $50 after 1 year. You'll have earned $50 as profit. B. Interest rate understanding. If you borrow $500 from a bank at an interest rate of 8% for 2 years, how much extra money will you need to pay back as interest? Answer. Interest equals $500 asterisk 8% equals $40. You'll need to pay an extra $40 as interest on top of the $500 you borrowed. Importance and advantages/disadvantages. Importance. Understanding yield and interest rates is crucial for investors because they help you make informed decisions about your investments. Knowing the yield helps you assess how much profit you can expect from an investment. Being aware of interest rates is essential when borrowing money or investing in debt securities like bonds. Advantages of yield. Helps investors compare different investment options and choose the most profitable one. Allows investors to understand how much they can expect to earn annually from their investments. Disadvantages of yield. Yield doesn't consider potential risks associated with an investment, so a higher yield might mean higher risk. It may not accurately reflect future earnings, especially for volatile investments. Advantages of interest rate. Helps borrowers understand the cost of borrowing money and plan their repayment. Allows investors to estimate their returns from fixed income securities like bonds. Disadvantages of interest rate. High interest rates can make borrowing more expensive, which may discourage investments in spending. Interest rates are influenced by various factors, making them challenging to predict accurately. Understanding yield and interest rates helps you manage your finances better, whether you're an investor or a borrower. It allows you to make informed decisions and take advantage of profitable opportunities while being aware of potential risks. 12 key points to understand yield versus interest rate yield. It refers to the profit an investor earns from an investment, like stocks or bonds, over a specific period. It includes interest and dividends received from the investment. Interest rate. This is the percentage charged by a lender when you borrow money, and it's the additional amount you need to pay back. It also represents the regular return an investor can expect from debt investments like bonds. Yield on bonds. In bonds, yield includes interest payments known as the coupon. It shows the annual profit you can make from holding the bond. Yield on stocks. For stocks, yield doesn't mean profit from selling shares, but rather the return from dividends received as a shareholder. Yield can be annual. It's usually reported as an annual percentage of your investment. Calculating yield, for example, if PepsiCo pays a $0.50 quarterly dividend and the stock price is $50, the annual dividend yield is 4%, $0.50/$50 asterisk 100. Yield to maturity, YTM. In bonds, YTM is the total return you expect to receive by the time the bond matures, based on the bond issuer's agreed interest rate. Interest rate on loans. When you borrow money, the interest rate is the percentage charged by the lender on the borrowed amount annually. Simple interest versus compounded interest. Simple interest is calculated only on the original amount, while compounded interest includes interest on the interest accumulated over time. Coupon rate. This is the interest rate or regular payment you receive as an investor when you buy a bond. Nominal versus real interest rate. Nominal rate is the quoted rate, while the real rate accounts for inflation. Real rate equals nominal rate, inflation rate. Effective rate. This rate includes compounding and is higher for loans or bonds with more frequent interest calculations. Importance of interest rates. Current interest. Rates affect borrowing costs, savings account returns, and bond yields. The Federal Reserve influences key interest rates that, in turn, impact other lending rates. Importance. Understanding yield and interest rates helps you make wise investment and borrowing decisions. It lets you know how much profit you can expect from investments and how much you'll pay when borrowing. Being aware of interest rates can also help you plan your finances better, whether you're investing or taking out loans. All right, so let's break it down into simple terms. Interest rates are like the price you pay for borrowing money. When you borrow money from someone, you have to pay them back the original amount plus some extra money, which is the interest. This extra money compensates the lender for letting you use their money. The market interest rate is the interest rate that happens in the real world when people lend and borrow money. It's not fixed and can change depending on a few important things. Here are the main factors that influence market interest rates. Inflation. This is when prices for goods and services increase over time. When inflation goes up, the market interest rate also tends to go up. This is because lenders want to be compensated for the higher prices of things when they get their money back. Alternative investments. When you lend money, you're giving up the opportunity to invest it somewhere else. So, if there are other attractive investment options with higher returns, lenders may ask for higher interest rates to make up for that potential profit they could have earned elsewhere. Risk of investment. Lending money always carries some risk. There's a chance that the borrower may not be able to pay it back, for various reasons like going bankrupt or simply not fulfilling their obligations. So, higher risk loans usually come with higher interest rates to account for that uncertainty. Liquidity preference. This is about how easily you can turn an asset, like money, into cash. If people want to have cash readily available, it can reduce the supply of available money, leading to higher interest rates. When people are willing to hold onto more money for immediate use, lenders may ask for higher interest rates since they don't have as much money to lend. To sum it up, the market interest rate is influenced by inflation, other investment opportunities, the level of risk involved, and how willing people are to keep cash in hand. Remember, interest rates are crucial for businesses and individuals making financial decisions, as they affect borrowing costs and investment returns. Imagine you want to borrow money from someone. They agree to lend you the money, but they want something extra in return for letting you use their money. That extra thing is called interest. Interest is like a fee you pay for borrowing money, and the market interest rate is the standard rate at which most people lend and borrow money. Mental models and analogies. Money rental shop. Think of interest rates like renting money from a money rental shop. When you borrow money, you're renting it, and the interest is the rental fee you pay for using the money. Weather forecast. Interest rates can be influenced by factors like inflation, risks, and preferences. Think of these factors as weather conditions that affect interest rates. For example, high inflation could be like a hot and sunny day, making interest rates go up. On the other hand, low inflation might be like a cool and rainy day, bringing interest rates down. Example exercises. A. Question. What are some factors that influence market interest rates? Some factors include inflation, alternative investments, risk of investment, and liquidity preference. B. Question. How does inflation affect interest rates? If inflation is expected to rise, interest rates tend to go up. This is because lenders want to be compensated for the higher prices they will face when they get their money back. C. Question. Why do lenders charge a risk premium on loans? Lenders charge a risk premium to protect themselves in case the borrower cannot repay the loan due to default, bankruptcy, or other reasons. The higher the risk, the higher the interest rate to account for this possibility. Advantages and disadvantages and importance. Advantages. Understanding interest rates helps businesses and individuals make informed financial decisions, like whether to borrow money or invest in certain assets. It enables businesses to calculate the cost of capital and determine the profitability of potential investments. Knowledge of interest rates is essential for financial planning and budgeting. Disadvantages. High interest rates can make borrowing more expensive for businesses, potentially hindering growth. Low interest rates can lead to inflation and asset bubbles, which can create economic instability. Importance. Interest rates play a crucial role in the overall economy, influencing borrowing, spending, and investment decisions. Governments and central banks use interest rates as a tool to manage inflation and stimulate or slow down economic growth. For businesses, understanding interest rates helps with strategic financial planning and risk management. Remember, learning about interest rates can empower you to make better financial choices and understand how the economy works. It's a fundamental concept in the world of finance and impacts various aspects of our lives. 15 key points to understand in depth about interest rates, required return, and inflation in a financial setting. Market interest rate. It's the rate at which borrowers pay interest to lenders for borrowing money. It's influenced by various factors. Determinants of market interest rates. The major factors affecting interest rates are inflationary expectations, alternative investments, risk of investment, and liquidity preference. Inflation. Inflation is the increase in the general level of prices over time. When inflation goes up, interest rates tend to rise as well. Inflationary expectations. People expect prices to rise in the future, so borrowers need to compensate lenders for this by paying higher interest rates. Alternative investments. Lenders have choices to invest their money in different assets. If they choose one investment, they forego the returns from other options, leading to higher interest rates. Risk of investment. All investments carry risks, and lenders charge a risk premium to be compensated for potential losses from borrowers who might default. Liquidity preference. People prefer having resources readily available for use. If more people hold on to cash, the money supply shrinks, leading to higher interest rates. Deferred consumption. When people lend money, they defer consuming goods now in exchange for future repayment with interest. Interest rate risk. It's the potential loss for bond owners due to fluctuating interest rates, which can impact the value of their investments. Market impact. Interest rates influence various financial markets like the money market, bond market, stock market, and currency market. Interest rate pricing model. The basic formula, N equals IR plus P plus R plus ULP, helps calculate interest rates for assets by considering risk-free cost of capital, inflationary expectations, risk premium, and liquidity premium. Risk-free return to capital, RR. This is the return lenders expect without taking any risks, like investing in very safe assets such as U.S. Treasury bills. Nominal interest rate, IN. It's the interest rate on a specific investment, determined by the interest rate pricing model. Transaction costs. The expenses incurred during a financial transaction, which can affect the overall return on an investment. Importance of understanding interest rates. Interest rates impact borrowing costs, investment returns, and overall economic activity. Businesses and individuals need to understand them for financial decision-making. By grasping these key points, you'll have a solid understanding of how interest rates work, their determinants, and why they play a vital role in financial decisions. Okay, imagine you're shopping for loans from different banks, and you notice something interesting. The interest rates they offer change depending on how long you want to borrow the money for. This changing pattern of interest rates is called the term structure of interest rates, and people often refer to it as the yield curve. Now, there are three main ideas that try to explain why these interest rates change over time. Expectation hypothesis. This theory says that the long-term interest rate depends on what people expect the short-term interest rate to be in the future. So if everyone expects short-term rates to go up, long-term rates will be higher too. It also adds a little extra amount called a risk premium to compensate for taking longer-term risks. Liquidity premium theory. This theory suggests that long-term interest rates not only depend on expectations, but also include an extra amount as a reward for holding on to a long-term investment. This extra reward is because long-term investments tie up your money for a longer period, and there's more uncertainty over time. So long-term rates are higher than short-term rates to make it worth investing for a longer time. Segmented market hypothesis. According to this theory, short-term and long-term investments are like apples and oranges. They are not easily substitutable. Some investors prefer short-term investments because they want their money to be more easily accessible. Others are okay with long-term investments because they seek better rewards for taking on longer-term risks. Since the supply and demand for short and long-term investments are separate, it can explain why sometimes short-term rates are lower than long-term rates, creating an upward-sloping yield curve. Each theory has its strengths and weaknesses in explaining the yield curve. The segmented market hypothesis, for example, can explain why short-term rates are usually lower than long-term rates, but doesn't fully account for the movements of rates together over time. The yield curve is an essential tool for understanding how interest rates work, and it can help investors make decisions about borrowing and lending money. Sure, let's break down the topic of the term structure of interest rates and the yield curve with some mental models and simple explanations. Mental model. Time-traveling bank. Imagine you have a special bank that lets you travel through time to borrow money. This bank has different term options for loans, ranging from short-term, less than a year, to long-term 10, 20, 30 years, etc. The bank's interest rates change depending on how far into the future you want to borrow money. The pattern of these interest rates over time is called the term structure of interest rates, or the yield curve. Mental model. Gradual hill of interest. Think of the yield curve as a hill. On the left side of the hill, you have short-term loans, like 1 year, and the interest rates are lower, maybe starting at 2%. As you move up the hill towards the right, the loans get longer term, like 30 years, and the interest rates gradually increase, say up to 5%. So, the curve shows how interest rates rise as you borrow money for a longer time. Quiz. What does the term yield curve represent? Answer. The yield curve shows how interest rates change over time for different loan durations. What is the term structure of interest rates? Answer. The term structure of interest rates is the relationship between the interest rates and the maturity length of a loan. How does the liquidity premium theory explain long-term interest rates? Answer. The liquidity premium theory says that long-term interest rates not only depend on future interest rate expectations, but also include an extra reward, premium, for holding long-term investments. This is because investing for a longer time comes with added risks and uncertainty. Mental Model 3. Market for apples and oranges. Imagine you have two separate markets, one for apples and one for oranges. In the financial world, these markets represent short-term and long-term financial instruments. People have different preferences. Some want apples short-term because they are easier to eat and change, while others prefer oranges long-term for their unique taste and health benefits. Advantages and disadvantages. Advantages of understanding the term structure of interest rates and the yield curve. Predicting economic changes. The yield curve can help predict economic changes. For example, when it inverts, short-term rates become higher than long-term rates. It often signals an upcoming economic downturn. Investment decisions. Investors use the yield curve to make decisions about buying or selling bonds. They look for opportunities to get higher returns by understanding the different rates over time. Disadvantages. Complexity. The topic can be complex and challenging to grasp fully, especially with different economic theories attempting to explain the yield curve. Market volatility. The yield curve can be affected by various factors, including changes in market expectations and economic conditions, making it sometimes difficult to interpret. Why is this important to know? Understanding the term structure of interest rates and the yield curve is crucial for several reasons. Financial planning. It helps individuals and businesses make informed decisions about borrowing and investing for both short-term and long-term needs. Economic indicators. The yield curve can act as a leading indicator for the economy, providing insights into potential recessions or growth periods. Investment strategies. Investors use the yield curve to create strategies for maximizing returns and managing risks in their portfolios. Policy implications. Central banks and policymakers consider the yield curve when making decisions on monetary policies to manage inflation and economic stability. By grasping these concepts, you can gain valuable insights into the financial world and make better informed decisions about your money. Keep practicing and asking questions to deepen your understanding. 15 key points to understand the term structure of interest rates and the yield curve term structure of interest rates. It's about how interest rates change over time. Yield curve. This is another name for the term structure. It's like a line graph showing how interest rates vary based on the time you borrow money. Expectation hypothesis. This theory says that long-term interest rates depend on what people expect the short-term rates to be in the future. Plus, There's a little extra money added for taking on longer-term risks. Liquidity premium theory. According to this theory, long-term interest rates include a bonus for holding onto long-term investments. This extra reward compensates for the risks and uncertainty that come with investing for a longer time. Segmented market hypothesis. Here, we imagine separate markets for short-term and long-term investments. People decide in advance what kind of investment they want. If they prefer easily accessible money, they go for short-term investments, leading to higher demand, higher prices, and lower yields, interest rates. Key terms: liquidity premium, an extra amount given to compensate for the inconvenience of holding a long-term investment. Premium, an extra price above the standard value at which a security is sold. Premium bond, a bond bought at a price higher than its regular value. Risk premium, extra money investors expect to get on a risky investment to make it more appealing than a safer one. Term structure of interest rates, the relationship between interest rates and how long a debt contract lasts. Yield curve, a line graph showing interest rates for different lengths of time. Time to maturity, the length of time until a bond or debt contract expires, ranging from short-term, less than a year, to long-term, 10, 20, 30 years, etc. Video resource. You can watch a video about the risk-free yield curve, which helps you understand this concept better. Economic theories. There are three main theories trying to explain the term structure. Expectation hypothesis. Long-term rates depend on what people expect short-term rates to be, plus extra risk premium. Liquidity premium theory. Long-term rates have a bonus for holding long-term investments. Segmented market hypothesis. Short and long-term investments are like apples and oranges, not easily substitutable. Pros and cons of theories. Expectation hypothesis neglects risks in investing in bonds. Liquidity premium theory explains higher long-term rates, but doesn't fully explain the movements of rates together. Segmented market hypothesis explains lower short-term rates, but fails to explain the correlation of rate movements. Advantages of understanding: helps with financial planning and decision-making, can predict economic changes and indicate future recessions or growth periods, assists with investment strategies for higher returns and risk management. Disadvantages: the topic can be complex and challenging to grasp fully. The yield curve can be influenced by various factors, making it sometimes hard to interpret. Importance of knowing: it's crucial for financial planning, economic prediction, investment strategies, and policymaking. Helps you make informed decisions about borrowing, investing, and understanding market conditions. Remember, the yield curve is like a map of interest rates over time, and different theories help explain why it changes the way it does. Understanding these concepts will help you make better decisions about borrowing, investing, and planning your finances. Keep exploring and practicing to deepen your understanding. Inflation is when prices of goods and services go up over time, so the same amount of money buys you less than before. It's something we all experience as we notice things getting more expensive, like rent, lunch, or even milk and movie tickets. A little bit of inflation, around 2 to 3%, is considered normal and can actually help the economy grow. But too much inflation, like hyperinflation, can be disastrous because prices rise uncontrollably fast, making money almost worthless. On the other hand, stagflation is when the economy is doing poorly with both high inflation and unemployment. There's also deflation, which is when prices drop. While it may seem good because things get cheaper, it can lead to companies earning less money and laying off workers, causing more unemployment. Different economists have different ideas about what causes inflation. Some think it happens when production costs rise or when there's too much demand for products. Others believe it's mainly because there's more money circulating in the economy. They have different views on how the government should handle it too. In short, inflation is the increase in prices over time, and it can be good in moderation, but too much of it can cause big problems. Economists have different opinions on what causes it and how to deal with it. Let's break down the topic of inflation using simple terms, mental models, and examples to help you understand and remember it better. Simple explanation of inflation. Inflation is when prices of things we buy, like food, clothes, and services keep going up over time. When there's inflation, the same amount of money you have buys you less than before. So things become more expensive, and the value of money decreases. Mental model: the balloon effect. Imagine the economy as a big balloon, and prices are like air inside the balloon. When the economy is doing well, the balloon slowly expands, and prices rise a little bit. That's normal inflation. But if too much air, inflation, gets pumped into the balloon too quickly, it can burst, hyperinflation, causing a lot of problems. Example exercise. A. What is inflation? Inflation is the general increase in prices of goods and services over time. B. How does inflation affect the value of money? Inflation makes the value of money go down because it can't buy as much as before. C. Can you give an example of a time when there was hyperinflation in history? An example of hyperinflation in history is Germany during the early 1920s, when prices rose rapidly, reaching 30,000% per month. Advantages and disadvantages of inflation, and its importance to know. Advantages: a little inflation is normal and can help the economy grow because it encourages people to spend and invest. It allows wages to increase, so people may earn more money. Disadvantages: too much inflation can lead to hyperinflation, which destroys the value of money and causes economic chaos. High inflation can make it hard for people to afford basic things, like food and housing. Importance: understanding inflation is crucial because make decisions to control inflation and maintain a stable economy. By understanding inflation and its different types, you can have a better grasp of how it impacts the economy and your own finances. Keep in mind that inflation is a complex topic, but with simple explanations and mental models, you can build a solid foundation to understand its effects and importance. 15 key points about inflation. Inflation is when prices for things like food, clothes, and services go up over time, making money buy less than before. It's a common experience for everyone as we see prices creeping upward, like rents or movie tickets. Inflation is measured as the rate at which prices increase in the economy over a period of time. When there's inflation, the value of money decreases, and it can't buy as much as it used to. This is called a decline in the purchasing power of money. Central banks try to keep inflation around 2% to 3% because a little inflation can help the economy grow. But if inflation goes much beyond this range, it can lead to serious problems like hyperinflation or stagflation. Hyperinflation is when inflation rises uncontrollably fast, making money almost worthless. Stagflation is a tricky situation with both high inflation and slow economic growth, along with high unemployment. Deflation is the opposite of inflation, where prices drop, but it can also cause economic issues, like companies laying off workers. Germany in the 1920s and Zimbabwe in 2008 are famous examples of hyperinflation, with insanely high price increases. Stagflation is rare but has happened, causing headaches for central banks in the past. Economists have different theories about what causes inflation, with two main schools of thought: Keynesian and monetarist economics. Keynesians believe inflation can happen due to increased production costs or higher demand for goods and services. Monetarists think inflation is mainly caused by an expanding money supply, meaning more money circulating in the economy. Understanding inflation is crucial because it affects everyone's daily lives and helps policymakers make important decisions about the economy. These key points should give you a good foundation to understand inflation and its various aspects in simple terms. Opportunity cost is a concept that refers to the potential benefits we miss out on when we choose one option over another. It's like when you decide to spend your money on a new phone instead of saving it for a vacation. The cost of the vacation you didn't take is the opportunity cost. To understand opportunity cost, you need to consider all the different choices available and compare the costs and benefits of each option. This helps you make better decisions in life and in business. Opportunity cost is not a physical cost you can see, so it's often overlooked. But thinking about it can guide you to make more profitable choices. For example, if a company invests money in one project instead of another, the potential return from the second project is the opportunity cost of choosing the first one. The formula to calculate opportunity cost is simply the difference between the expected returns of each option. It's essential to consider opportunity cost when making decisions about things like investments, capital structure, or business strategies. Opportunity cost is different from a sunk cost, which is money already spent in the past and can't be recovered. Opportunity cost looks ahead to potential future returns. Making decisions based on opportunity cost can help you prioritize the most profitable options and make better long-term choices. Remember, opportunity costs are everywhere. In big decisions like buying a house and small choices like buying a candy bar. So it's important to think about the alternatives and potential benefits before making a decision. I'll break down the concept of opportunity cost using simple terms and provide some mental models to help you understand better. 1. Simple explanation. Opportunity cost is like when you have to choose between two options, and whatever you give up by choosing one is the opportunity cost. It's the hidden benefit you miss out on from the option you didn't choose. 2. Mental models. A. Imagine you have $10, and you can either buy a movie ticket or a video game. If you buy the movie ticket, the opportunity cost is the fun and enjoyment you would have had from playing the video game. B. Picture yourself standing in line to buy a delicious ice cream cone, but then you see a yummy-looking chocolate cake at the next stall. If you buy the ice cream, the opportunity cost is the taste and delight of eating the chocolate cake. Example exercises. A. You have $50, and you can either spend it on a new book or save it for a future trip. What's the opportunity cost of buying the book? Answer. The opportunity cost is the excitement and experiences you would have gained from using that money on your trip. B. You are a business owner with $10,000 to invest. Option A is to invest in a new technology that might improve productivity, and option B is to hire a salesperson to bring in more customers. If you choose option A, what's the opportunity cost? Answer. The opportunity cost is the potential sales and revenue you could have gained from hiring the salesperson. Advantages and disadvantages and importance. Advantages. Helps you make better decisions by considering all options and their potential benefits. Enables individuals and businesses to prioritize and choose the most profitable path. Useful for determining the best capital structure and investment choices for a company. Disadvantages. It can be challenging to calculate accurately as it involves future predictions and assumptions. Sometimes opportunity costs are intangible, making them difficult to quantify. People may overlook opportunity costs and focus only on immediate gains. Importance. Understanding opportunity cost guides you to make more informed choices in both personal and business matters. It's crucial for investors to compare different investment options and evaluate potential returns. Businesses can use opportunity cost analysis to optimize their strategies and increase profitability. Knowing about opportunity cost empowers you to think critically about the value of your choices and consider the potential gains you might miss out on. It's a valuable tool for making smarter, forward-looking decisions in various aspects of life. 15 key points to know in depth about opportunity cost definition. Opportunity cost refers to the potential benefits or returns that are missed out on when you choose one option over another. Unseen cost. Opportunity costs are hidden because they are not directly visible, making them easy to overlook when making decisions. Better decision making. Understanding opportunity cost helps individuals and businesses make better choices by considering all available options. Internal cost. Opportunity cost is an internal consideration and not part of accounting profit or external financial reporting. Formula. The formula to calculate opportunity cost is the difference between the expected returns of the chosen option and the best foregone option. Mutually exclusive options. When faced with mutually exclusive options, choosing one means forgoing the benefits of the other. Capital structure. Opportunity cost analysis is crucial for businesses to decide between issuing debt or equity capital to fund projects. Risk consideration. Businesses need to compare investment options with similar risk levels to make meaningful opportunity cost evaluations. Comparing investments. Businesses assess potential profitability by comparing the expected rate of return, ROR, of different investment options. Importance of time. Opportunity cost considers the impact of time on investment returns and future profits. The most expensive pizza. An example of opportunity cost is the 2010 Bitcoin exchange for pizza, which would now be worth millions. Difference from sunk cost. Sunk cost is past money spent, whereas opportunity cost is about potential returns not earned. Decision-making for investors. Opportunity cost plays a role in investors choosing between risky and less risky investments. Economic profit versus accounting profit. Economic profit includes opportunity cost as an expense, while accounting profit does not. Everyday decision-making. Opportunity costs are present in everyday choices, and considering them can lead to wiser financial decisions. Understanding opportunity cost is crucial for making informed decisions in personal and business scenarios, as it helps you assess the true value of different choices and avoid missing out on potentially better outcomes. Imagine you have some money in your hands and you need to decide what to do with it. The cost of money is about the choice between keeping that money with you right now or investing it somewhere else. This decision depends on how much extra money you could make by investing it and getting interest. Let's break it down. Time value of money. Money today is worth more than the same amount of money in the future because of the interest you can earn over time. Interest rate. The interest rate is the extra money you get for keeping your money in an investment. It's like a fee you earn for letting someone else use your money. Opportunity cost. When you choose one option, you miss out on the benefits of the other options. The cost of money is about considering what you could have gained by choosing differently. Choice: spend or save. You have two choices. Spend the money right now or save it for later. If you save it, you can earn more money through compound interest, which means you get interest on your interest. So, the cost of money is all about making smart decisions with your money, considering what you could gain by investing it and what you might miss out on by keeping it with you. It's important to think about the value of money over time and make choices that will help you grow your wealth. Let's break down the concept of the cost of money using simple terms, mental models, and examples. Simple explanation. The cost of money is about the choice between keeping your money with you now or investing it somewhere else. It's like deciding whether to spend your money immediately or save it for later, considering the extra money you could make through interest. Mental model. Imagine you have a piggy bank and you're trying to decide whether to keep all your money in it or put some in a magic investment machine. The magic machine gives you extra coins for every coin you put in. The more time you keep your money in the machine, the more extra coins you get. The cost of money is about figuring out if it's better to keep your money safe in the piggy bank or put it in the magic machine to grow even more coins. Example exercises. Exercise 1. You have $100 now. You can either spend it on a new video game or invest it in a savings account with a 5% interest rate. What is the cost of money if you choose to spend it on the video game? If you spend the $100 on the video game, the cost of money is the potential extra money you could have earned if you invested it. So it's 5% of $100, which is $5. Exercise 2. You have $200 and can either buy a new gadget or invest it in a bond with a 3% interest rate. What is the cost of money if you decide to invest in the bond? If you invest the $200 in the bond, the cost of money is the extra money you could make from the bond. So it's 3% of $200, which is $6. Advantages and disadvantages. Advantages. Understanding the cost of money helps you make smarter financial decisions. It allows you to evaluate whether it's better to spend money now or invest for future gains. Knowing the concept of opportunity cost helps you consider the best alternatives for growing your money. Disadvantages. It can be tricky to accurately predict future interest rates and investment returns. Opportunity cost might not show up directly in financial statements, making it less visible. Why it's important to know. Knowing the cost of money helps you avoid making impulsive spending decisions and encourages you to think about long-term financial growth. By considering the opportunity cost, you can make wiser choices with your money and build wealth over time. It's a valuable skill for financial planning and investment decisions. Cost of money. It's about deciding between keeping your money now or investing it somewhere else. Time value of money. Money today is worth more than the same amount in the future. Trade-off. Choosing between spending money now, holding, or investing for future gains. Interest rate. the percentage charged for using money, or the cost of not having money for a period. Opportunity cost, the cost of giving up the best alternative when you make a decision. Decision making, consider the rate of interest you could earn by investing before making choices. Time preference, people prefer to have money now rather than in the future. Present value, the value of money today that will be worth more in the future due to interest. Compound interest, money grows over time if invested and earns interest on the interest. Investors' options, keep money now, spend, or save it, invest. Financial compensation, money grows through compound interest when saved. Financial planning, understanding opportunity cost helps make better financial decisions. Long-term perspective, thinking about future benefits of investments and savings. Calculations, estimating future interest rates and investment returns for decision-making. Wealth building, opportunity cost plays a role in building wealth and financial success. Advantages, helps in making informed financial decisions. Encourages considering long-term benefits. Assists in evaluating investment choices. Disadvantages, predicting future interest rates can be challenging. Opportunity cost might not be directly visible in financial statements. Importance of knowing. Importance, understanding the cost of money and opportunity cost is crucial for making smart financial choices. It helps you weigh the benefits of spending money now versus saving or investing for future growth. Knowing this concept is essential for financial planning, wealth building, and achieving your financial goals. Interest rates and how they affect the economy. Imagine you borrow some money from a friend, and they ask you to pay them back with a little extra money as a thank you for letting you borrow it. That extra money you pay back is called interest, and the interest rate is the percentage of that extra money you need to give them. In the big world of economics, countries have a central bank. In the U.S., it's called the Federal Reserve, or the Fed, that controls the supply of money to help the economy grow and stay stable. One way they do this is by setting a target interest rate, and that's the rate they want banks to charge each other for short-term loans. When the economy is not doing well, and there's not enough growth in jobs, the central bank may lower the interest rates. This is called an expansionary monetary policy. By doing this, they hope that businesses will find it easier to borrow money and invest in growing their companies, which can create more jobs and boost the economy. On the other hand, if the economy is growing too fast and prices are rising too quickly, inflation, the central bank might raise interest rates. This is called a contractionary monetary policy. The higher interest rates make it more expensive for businesses and people to borrow money, so they might spend less, which can slow down the economy and help keep inflation in check. But here's the thing. When the government spends a lot of money on things like infrastructure, education, or healthcare, it's called expansionary fiscal policy. This can also boost the economy, but sometimes it can cause interest rates to rise. When interest rates go up, it becomes more expensive for businesses to borrow money for investments, and they may end up spending less. This situation, where government spending leads to higher interest rates, and then businesses spend less, is known as crowding out. It's like there's only so much money available to borrow, and when the government takes a big chunk of it, there's less left for businesses. So interest rates are a powerful tool that the central bank uses to influence the economy, and they can have a big impact on how businesses and people make decisions about borrowing and spending money. Sure, let's break down the topic of interest rates and monetary policies using some simple explanations, mental models, and examples. Simple explanation. Interest rate. It's like paying a small fee for borrowing money from someone. The interest rate is the percentage of that fee you have to pay back along with the borrowed money. Monetary policy. It's like using a special tool to control the flow of money in the country. The government does this to make sure the economy stays healthy and people can find jobs. Mental models and analogies. Water tap model. Think of interest rates as a tap controlling the flow of money in the economy. When the economy needs more money, the tap is opened by lowering interest rates. Expansionary policy. When the economy needs to slow down, the tap is closed by raising interest rates. Contractionary policy. Thermometer model. Imagine the economy is like a thermometer, and interest rates are the temperature. When the economy is too cold, unemployment and slow growth, the central bank uses expansionary policies to warm it up. When it's too hot, inflation, they use contractionary policies to cool it down. Example exercises. At what does expansionary monetary policy mean and when is it used? B. Explain crowding out with a real-life scenario. C. Why might lowering interest rates lead to economic bubbles? Expansionary monetary policy means the government is trying to boost the economy. They do this by lowering interest rates, which makes it easier for businesses to borrow and expand. It's used during recessions to combat unemployment. Crowding out happens when the government spends a lot of money, causing interest rates to rise. This makes it expensive for businesses to borrow money, so they spend less, reducing investment in the economy. Lowering interest rates can make borrowing money cheap, so people and businesses borrow a lot, causing excessive investments. Sometimes this can lead to economic bubbles, like when too much money is invested in real estate or stocks, creating unsustainable growth. Advantages and disadvantages. Advantages of monetary policy. It helps stabilize the economy, create jobs, and control inflation. By adjusting interest rates, the government can influence spending and investment. Disadvantages. Sometimes it's hard to predict the exact impact of changes in interest rates. Also, if not used carefully, it can lead to economic bubbles or inflation getting out of control. Importance of knowing. Understanding interest rates and monetary policies is crucial because they affect everyone's lives. They influence how easy or expensive it is to borrow money, buy homes, start businesses, and find jobs. Being aware of these policies helps. Individuals and businesses make informed financial decisions and prepare for economic changes. 15 key points to understand in depth about interest rates, monetary policies, and related concepts. Interest rate. It's the fee borrowers pay to lenders for using their money. Monetary policy. How the government controls the supply of money to promote economic growth and stability. Federal Reserve, the Fed. The central bank of the U.S. responsible for monetary policies. Federal funds rate. The interest rate banks charge each other for short-term loans. Expansionary monetary policy. Used in a recession to combat unemployment by lowering interest rates and increasing money supply. Contractionary monetary policy. Used to control inflation by raising interest rates and reducing money supply. Crowding out. When government spending leads to higher interest rates, reducing private investment. Target interest rate. The rate set by the central bank to achieve economic goals. Inflation. The increase in prices of goods and services over time. Recession. A period of economic decline, usually involving unemployment and reduced growth. Aggregate demand. The total demand for goods and services in the economy. Expansionary fiscal policy. When the government increases spending or lowers taxes to boost the economy. Contractionary fiscal policy. When the government decreases spending or raises taxes to slow down the economy. Equilibrium income. The level of income where aggregate demand equals aggregate supply. Economic bubbles. When prices of assets like real estate or stocks rise rapidly and unsustainably. Why is this important to know? Understanding interest rates and monetary policies is essential because they impact the entire economy. Changes in interest rates affect borrowing costs for individuals and businesses, influencing spending, investment, and job creation. Monetary policies play a crucial role in stabilizing the economy during recessions and controlling inflation during periods of rapid growth. Fiscal policies also influence economic growth by adjusting government spending and taxes. Being aware of these concepts helps individuals, businesses, and policymakers make informed decisions to navigate economic conditions and promote a healthy and stable economy.